Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we welcome Dave Sachse, managing partner at the Sachse Family Fund, to discuss how family offices are navigating the current venture market. We discuss how David's family office originally got started and how their investment thesis has evolved over the years. We cover how they source investment opportunities and what their typical due diligence process looks like. We also asked David to share how his family office assesses emerging managers in venture and how LPs should be using some standard benchmarks to compare fund managers right now. Lastly, David shares his honest views on why it is so wrong for LPs to charge fund managers to pitch them for investment capital. But before we get started today, as our listeners probably know by now, the team at Ripple is always focused on helping our founders and portfolio companies find the best partners to work with. And when it comes to corporate finance and cash management, there's nobody we recommend more than the team at Jeeves. At Ripple, we manage all our fund expenses and employee credit cards using Jeeves. The team at Jeeves helped me get my team set up with physical and virtual cards in days. I was able to allow my teammates to expense items in multiple currencies, allowing them to pay for anything, anywhere, at any time. We weren't asked for any personal guarantees or to pay any setup or monthly SaaS fees. Not only does Jeeves save us time, but they also give us up to 3% cash back on our purchases, including expenses like Google, Facebook, or AWS every month. The best part is Jeeves puts up the cash and you settle once every 30 days in any currency you want, unlike some other corporate card companies that make you prepay every month. Listeners of Tank Talks can get set up today with a demo of Jeeves and take advantage of our Tank Talks special with a $250 sign-up bonus and skip the waitlist that already has thousands of companies waiting on it by visiting tryjeeves.com/Tank Talks. Use referral code Tank Talks to get set up today. Now let's jump into the tank for this week's episode with David Sachse from the Sachse Family Fund. Thanks for joining us in the tank today, Dave.
Matt, thanks for having me. Excited to be here.
You know, I appreciate you taking the time to share your thoughts on the venture capital markets in what's going on these days with limited partners and family offices, and how they're thinking about investing in the market and the opportunities they're seeing out there. But before we get started, Dave, I would love it if you can give a brief background on how you ended up in the investment industry and how your family fund got started.
Yeah, great. Happy to do that. Grew up in the Wisconsin area and went to the corporate world. I actually was in a product manager of software. That's what exposed me to the tech world, and I got obsessed with technology then. I don't have a formal developer background, but definitely a computer and video game nerd growing up. And that was my first exposure. But how the family started a family office, I was very fortunate, lucky, blessed, privileged. My parents sold a manufacturing company, my father and late mother, in 2012. That made two core products, frozen ice cream machines and industrial computer washers. And that was essentially it in 2012. And that's how we started a quote unquote family office, but it's really my dad just doesn't have many hobbies and he likes helping out entrepreneurs and supporting the community. So where I got joined in with the family office wasn't until quite some time after. I quickly realized I was a little too aggressive for the corporate world, then started working on something nights and weekends to go launch my own startup. And that was an early stage technology platform where I tried to essentially have people get rewarded for the content they create online because I thought they should earn content they create online. So that was a great experience, but very challenging at the end of the day. How I got into the venture space, essentially from personal experience being a founder, I wanted to be the VC I wish I had. And I was very lucky, fortunate, blessed, privileged. My parents, I got some capital from my parents' acquisition. And being a tech data nerd, I invested heavily in public tech stocks. That gave my wife and I the means to start angel investing in 2017. And that's when I really more joined the family office in a formal role, as I was also consulting on technology solutions for a lot of our operating companies.
I love it. There's so many pieces of this puzzle here. One is that you were an active video game nerd, as you described it, but I'm sure your family saw that there wasn't a lot of future and money to be made in that. So they kind of opened up the kimono of what was being going on in the factory. But, the roots of what your family business started at was a true operating family, manufacturing business in Wisconsin. So as a kid, were you spending a lot of time learning about, business and walking around the factory and learning about the ropes of the business? And was there ever an opportunity for you to go work there? Or was the company already sold by the time you became of age to actually consider going into the family business?
Yeah, handle the first question or last question first. There didn't work for the family business. The family didn't necessarily want to mix that, and also the timing of it just didn't make sense for the capabilities and coming straight out of college. So I was very fortunate. I grew up in a family of entrepreneurs. My great grandparents had a retail store that my grandparents then run, and then my father and uncle, who are on my investment committee, worked at. But on top of that, I also, I worked in many entrepreneurial environments, whether that was my grandma's store, my aunt and uncle's restaurant, or even having my own window washing business in high school and college with 11 employees over that time. So I got exposed to a lot of entrepreneurial opportunities when I was younger, and that helped shape me.
Fantastic. So, as you mentioned, you kind of made your own headway into the technology investing world yourself from some of the capital that your family had given to you after the sale, even before the family was really set up to be a technology or family investment fund, correct?
Correct. Yeah. And I mean, even when I started angel investing in 2017, it's not like we had dinner over the weekend and the family's like, this is a great idea to throw money at a risky asset class when you just failed your startup. No, they weren't rushing to do that. I had to kind of prove it out over 2 years, and I was going to do it regardless if they were involved or not. And it was cool to work with them and have them on board.
Well, that's fantastic. You know, a lot of family offices that we work with at Ripple have the same sort of conversations where the second or third generation who necessarily aren't going into the family business or even built up the family wealth have so many things that they want to invest in that are unrelated to the family business. And there's this sort of contradiction between like wealth preservation versus wealth creation, generation to generation. You know, the saying goes, first generation builds it, second generation grows it, and third generation basically spends it. So it's really hard to make these transitions. And you obviously felt that as well. So how did you go about like starting to source investment opportunities and even, VC funds to invest alongside in the early days before the family office was really gung ho about it?
Yeah, in the early days, I mean, it's probably a classic example of what you hear often. It was solely focused on geo. So what was close to me were some accelerators like Generator and healthcare funds like HealthX Ventures, and those are some we supported early. But then it was just a gradual process of self-research and self-networking and putting myself out at different events across the country and trying to meet people. And I would say the pandemic was kind of a blessing in disguise, because then it didn't matter where you lived, and a lot less people cared if you were from Midwest or Wisconsin. And that helped me immensely, just from a networking standpoint, really expand just the volume of VCs and family offices that I interacted with.
So give us a taste of what were some of the early investments that you made that ended up working out before the family office sort of got going on, joining you along the ride.
Yeah, I mean, so 90% of our checks are pre-seed and seed, but we've had a couple that, we invested when it was less than 50 to 100K in revenue. And now those have anywhere from 3 to 5 million in revenue. And they were seeing the growth of that. And there was just internally, there was not as many people on board with some of the early investments that I did, but then they saw them kind of translate into revenue, like decent cash flowing businesses. Well, they weren't necessarily profitable, but they didn't have really wonky economics that made it, unsustainable to grow unless they had significant cash infusion.
Gotcha. And so talk to us about the transition. Like, how did the family come together and decide about, the investment thesis and, how they would, allocate capital in a portfolio of many assets, I'm sure, at the time when it started to become a real thing?
Yeah, I mean, it was definitely a process, and I'd say we had to start. So I started by learning by viewing, and I was doing like the fantasy portfolio and stuff in like the early 2010s on just what I would invest in. But then on top of that, when I had the capital, I was learning by doing, but I was doing it in a patient way and not deploying too quickly, and just making sure we would feel out what we liked and what we didn't like. I think it's almost as important to understand what you don't like versus what you like, especially as a family office where you get solicited a lot of different deals across many different asset classes. But I was pretty keen early on educating my own family to make sure, no, this isn't like private equity. We're not going to 20, 30, 50% of the companies. We're looking at 1 to 5% of these companies typically. So it was even an education process for my own family. And we did that not only with how the industry works, but with also how our portfolio construction is going to work. And I purposely did that because we have a lot of strong personalities in our family. And I didn't want a flavor of the week all of a sudden slap down a big check. The portfolio construction is out the window then. So, I was really keen on making sure we had check size that we stayed to, as well as a process of diligence.
That's really smart. That's a great way to do it from the beginning. So you mentioned you have your father and I think your uncle on the investment committee. Explain to us, exactly how the investment committee was structured and what is your typical due diligence process for eventually making capital commitments look like?
Yeah, so on the investment committee, we had 5 family members. We had 1 pass, so that was a challenging time over 2021. However, it actually created learning through growth for us because I had to implement a new check track, earlier stage check, where I acted more as a solo capitalist. Prior to that, our typical diligence process was 2 to 4 weeks. The fastest we acted was less than 1 week. And how I initially do it is I'll create an initial memo, and then keep adding to that memo throughout once I talk to the investment committee, in addition to do my back channeling and initial research. So every deal that we do, we have an investment memo, and every deal that we get excited about, we have usually a 70% investment memo created. So I'm very keen on documentation so that I can also learn myself from just trends I do as an investor.
Oh, that's fantastic. And it also helps you build, the muscle memory and the track record internally so that you can eventually scale it when maybe other people come in to work and support the family office that you can hand off some of those tasks to. So let's get into some of the specifics though. Talk to me about how you would assess an emerging manager in venture and how you've been able to think about qualitative metrics versus quantitative metrics, which unfortunately a lot of emerging managers just don't have to go on.
Yeah, I mean, and especially the last 2 years, as you know, that's tough with how frothy the markets were and with capital. But, a few things that we look at for assessing emerging managers, a big one is why are they doing it? Venture capital and startups to me are over glorified and they're not as fun as you read about. It's oftentimes a lot of grinding and hard work. So I dig hard into the why they're doing it. On top of that, though, I talk to them about the future. So if they're doing a fund, I would imagine they have a multi-decade outlook, especially if it's where I typically invest, and that's pre-seed to Series A type funds. And, if they don't, that's concerning, obviously. But if they do, I look at also at how they scale. So are they going from 10 million to 100 million, or are they going 10 million to 10 million or 10 million to 20 million? As you know, those are 2 different games that you're playing when you're talking about check sizes and rate of deployment and all sorts of stuff. But then the other big one is, you might laugh at this because I know it's kind of a taboo thing in the VC industry with value add, but I look at deal sourcing and value add. So how do they support companies outside of just their check? Now, that can be a variety of different ways, through distribution, through customers, through employee intros, all sorts of stuff. But I do look at that because that's important to me, because when we make investments, whether it's in a funder or fund manager or a founder, they're partners. They're a part of our team. You're not just a line item on our portfolio. We want to work with you. So we look at, how you operate beyond the check is a huge thing for us.
Yeah, those are great points. I'm so glad you mentioned them. The why is really important. I remember getting started and some people said, okay, you want to be a venture capitalist? Great. So get ready to basically not make any money for 10 to 20 years, basically have 99% of the time with shit on your face, in terms of just all the crap you're dealing with. And then eventually you may hit a home run, but it doesn't really happen overnight. So get ready to grind and hustle. And that's really what it is about. It's a lot of doing a lot of the grunt work and supporting founders through a lot of crappy times. And then sure enough, you get a couple press releases here that make you feel decently good, but it doesn't really happen overnight. And it's just a long journey. So I'm glad to hear you say that. What other things have you kind of experienced with the fund managers that you didn't know going into this that you think our listeners should know about?
Well, before that question, I wanted to tell you too. With my family, it was a learning journey just on venture where I had to articulate this capital's gone for 10 years at least. Like we can't call it back for a little bit or anything like that. It's not public markets. It's gone. It's gone for 10 years. So, like to your point about the long outlook and when investing early, that's how I articulate it to my family. But yeah, it's a daunting thing, and it doesn't sound exciting or enthusiastic until you understand like portfolio construction. But to your other question here about working with fund managers, it's been a blast. I've explored just gravitating towards fund managers that align kind of with my thesis or my style on how I treat entrepreneurs, how transparent I am, how direct I am. I can rub people the wrong way because I'm so direct sometimes. But if you work in a family office, you have to be. Otherwise, holidays suck, and it's just like you can't operate, and it'll just create animosity or strained relationships over time. So I try to gravitate to those that are similar styles, but also are wildly smarter than me and typically specialize or have a category that they're really strong at. Not necessarily just specialized, they're fun, but they're strong at certain things like fintech, cybersecurity, Web3, other stuff. And I lean on them versus pretending like I know how to analyze all this stuff.
Yeah, absolutely. I've made a handful of LP commitments through my family office as well. And those are exactly the things that I look for. It's like ancillary to what I can add directly from my own perspective is something that I just can't do and that I want to find in those emerging managers that I want to support. I got to ask though, there's a thing that everyone has sort of talked about over the last few years regarding sort of like the capital that emerging managers end up putting up in their own funds and how they don't have a lot of skin in the game. We do have a lot of skin in the game. I do personally in a lot of my funds. I was fortunate enough to have a career in finance before this, but a lot of GPs just don't have that. So how have you kind of viewed the sort of GP commitment in first or second funds from emerging managers? And how do you typically advise emerging managers on how to handle these conversations with other family offices?
Yeah, so I think skin in the game can be defined by a lot of other things than just your own capital. Oftentimes, I look at the opportunity cost of the individuals that are running the funds that are taking these low salaries and going to be grinding for a while. A lot of them are brilliantly smart people that could be working at many other different places if they wanted to. And just because they didn't put up 1% of the fund or X percent, to me, that doesn't necessarily matter. I know a lot of family offices or LPs may look at that differently. I think that's because family offices can get treated as an ATM often. So they're wondering, hey, why is this 2 and 20? You're just taking 2 and 20 here, or why are you doing it? Well, for me, talking to emerging managers about that, I would make sure to tell them about the opportunity cost and how a lot of the emerging managers that I'm supporting and have met, even like yourself, are living and breathing venture investing. And you're doing that from a multiple of facets. I mean, you have a podcast, you have a family office, you have a venture fund, you're doing a lot of different things. And not only is there financial risk, but there's reputational risk as well, and opportunity cost of, I'm grinding for a really long time where I don't know if this is going to work. You could be, especially when you have kids and stuff, it's a lot harder game than it is to just wait for that check for so long. So, I look at it opportunity costs, and I would make sure emerging managers understand when you're communicating to LPs and stuff like that, talk to them about the commitment you're making, and it's way beyond capital.
For sure. I think I kind of swing on both sides of this one. I think, like, obviously, if you do have capital, you should be putting your money where your mouth is. If you don't have capital, you're right. Explain the other sacrifices that you're making on why, this family office should depart from their, hard-earned capital that was created over generations and support you in your, promise and vision. So I think you're right on sharing more than just that.
But I would say, so if I were doing a fund and I was raising outside capital and Dave has 0 or less than 1%, there's something wrong there. And that gives off a terrible signal. I was more speaking to the emerging managers that maybe didn't have the financial means to make a capital commitment type thing. But to your point, that's a huge signal. I mean, it's why, when you see syndicates, they're raising 300, 500,000 and they're putting in 1,000 and they're getting 20% and it's their fifth syndicate they shared this week. Well, maybe they might not be in it or have as much skin in the game as you'd want. So it doesn't necessarily align always.
Yeah, it's exactly it. It's like if you can just pick any deal because you're not putting up your own capital, then what's the bar that you're trying to cross for your investors to see that is quality versus not quality? That's the sort of signal I think it also sends. Now, let's switch gears a little bit on terms of sort of like the way that emerging managers have typically showed returns in quotation marks to investors, where they've marked up, safe notes and converts and not accounting for dilution and return calculations. We've seen everything across the board. You tweeted out that if IRR and MOIC are inflated and gamed in today's market conditions, what other metrics should LPs be using to analyze fund managers? So what are the answers here?
Yeah, I mean, that's a tricky question and something I'm still trying to figure out myself. But I would say, if you're marking up your fund's performance based on safes and convertible notes only, especially after the last couple of years, it's a dangerous game. It can be super misleading. And, I definitely advise managers to go against that, or at least make sure you're being completely transparent. Something that I like to do at my family office is I like to showcase kind of an industry number and then a real number of what's happening. The real number is more about the health of the business and how they're performing from a customer standpoint, maybe revenue standpoint, but it doesn't necessarily matter about the last valuation they raised on. We have some where we put it at a 0 carrying value, even though they have some high valuations, but it's because the business is still figuring out product market fit. That's how I look at it. And I actually stress it's better to be transparent and direct with your LPs versus having them get surprised. So, I'm one that prefers to over deliver instead of over promise. So being very clear and articulate and transparent on your metrics and how those metrics are, what has built them up is, I think, really, really important, especially in this time with the macro environment.
Yeah, I couldn't agree more. I mean, we are extremely conservative. Sometimes our LPs say too conservative, where we only use third-party priced equity rounds for markups. So we never do safe or converts. We also showcase the revenue when we invested at where it was and where it currently is to show the growth of the company. And we also take, dilution into account all the way through. We have to. It's the only way to actually show true expected returns. So yeah, if we take a big 30% dilution round on a round, we don't keep our position at the same. We have to mark it down as well. And those are just things that I think everyone should eventually come to realize that it's going to come back to bite you in the ass if you just sort of try to keep this like high bar too high for too long, right?
Yeah, and I think managers right now should proactively be looking at, hey, which of our portfolio companies are going to be taking a haircut, and how could that impact our metrics? And just being clear about that, especially if you're raising a fund 2 off of those metrics, or just any fund. It doesn't have to be fund 2, but I think it's really important. And I've gone back and forth with other LPs on this, where they're like, well, they can't predict the future. Well, part of that is they should have company updates at least quarterly to have an idea on the health of the business. So you don't want to mislead, especially when you have a fiduciary responsibility where you're investing other people's capital.
Well, that's a no bueno for me. I mean, if we aren't getting monthly or quarterly updates, like that's not going to fly with our fund. So we wouldn't ask our LPs to ignore that as well in their own direct investments and angel investing. So thank you for sharing that. Another thing you also tweeted about was about, the current markets and how you're seeing very sort of bifurcated views on LPs and how they're, dealing with investment funds and VC funds right now. You said that hearing that 10 to 30% of LPs are asking their VCs to delay capital calls in this current market. So, is that true? And what else are you seeing out there in the VC world that our listeners should be aware of?
Yeah, it was something I anecdotally heard from a handful of VCs, actually some that I don't support. It just was interesting to me. And this was especially in Q1 and Q2 when the public markets were really getting hammered. And, what else should they look out for? I think it's important, especially nowadays, back to the why for, if you're talking to non-institutional VCs, you got to be asking these family offices, why are they doing what they're doing? And on top of that, both VCs and family offices should be asked about their deployable capital situation, because right now, fundraising is hard for everyone. Not just startups, the investors as well. And there's VCs that I know that actively take meetings, or family office that take meetings, even if they don't have deployable capital. And I think that's borderline criminal or misleading. Again, back to me being direct and stuff, where, I'm in a scenario right now working on my fund 2 where I'm not trying to take new meetings to the best of my ability until I get the funding for my deployable capital for the check size that I want. So I'm working on that right now and and it's not easy, although it feels a lot better and aligns with my values of being transparent and just direct with founders.
Yeah, I think those are great points that a lot of emerging managers especially should, use in their toolbox. Whereas you're going into an LP meeting, it's okay to ask, like, are you actively deploying, or do you plan to deploy sometime in the future? What's your time frame here, and doesn't align with our final close date, for example, or should we kind of push this conversation off for future funds? I think that's a great way of thinking about it. The things that we've also been hearing is that so many of the endowments and institutions were just so overweight a lot of venture capital dollars that they were just suffering from the denominator effect. Now, as sort of tech markets have sort of found a little bit of a bottom here, I mean, it changes every day, but for the most part, are you expecting to see LP commitments reemerge later this year or early next year? Or do you think we still need to see where the dust settles and if there's actual capital that can be extracted from this market in terms of exits if the IPO markets continue to be closed?
Yeah, I think it depends on stage where you're investing, but definitely for early stage, I think dust still needs to be settled a little bit. But you're seeing things come back to kind of pre-2020 where capital was very frothy. I would say also too, LPs are going to continue to be active, at least the serious ones. I think institutional LPs, that can be a tricky ball game with certain check sizes that they have to get into or that they have to put into certain funds. And that's why certain fund managers try to scale very quickly because they want to get institutional. So that's a unique game as well. But I see in the family office world, and I work with a network of about 30 family offices, I see LP commitments continuing, but just going to be more strategic and serious. Maybe not as, hey, I like you, I just want to support you, but what does this do for my deal flow and my venture strategy outside of me really liking you and wanting to support you in your journey? So I see a lot more family offices going to become a lot more sophisticated on strategy and portfolio construction. And I do believe that early stage venture funds will be a part of that. And it's just those, in my opinion, that over deliver and under promise are going to be the ones that make a lot of family offices happy and who are going to continue support. So if you have the markups and that are misleading, those are going to lead to hard conversations down the road when they've already signed on, and that can get real messy.
Yeah, great points there. I mean, we are actively trying to return capital from our first and second fund to LPs, in this market, which is a hard thing to do. So I think that will hopefully give us some good points with LPs. But you're right. It needs to be an open conversation, transparent, and where things are at. Everything can't be up and to the right forever. So this is definitely a transitory period for a lot of people in the industry. And we're seeing a lot of Twitter VC people just go zero dark 30 over the last several months. They haven't really been as active as they usually were. And it just tells an easy signal of where your actual commitments lie. For us, it's about staying at the top of people's news feeds, staying in the know, staying in the deal flow, and actively writing checks no matter where the market kind of moves, which is a part of the long-term strategy here. But, what kind of opportunities are you seeing right now with the family office? Are you doing more direct investments, fund investments? What kind of high quality opportunities are you seeing to take advantage of with your family office and other family offices that you work with?
Yeah, so I've deployed kind of a multi-prong approach here with investing in direct deals as well as venture funds. So to date, having the 17 venture funds that we've supported and 33 startups, every dollar that we put towards venture funds, I try to have 4 going to direct deals. I invested heavily into venture funds largely for access, knowledge, and just to get my foot in the door, honestly, Matt, where it's being a family office from Wisconsin, that title right there doesn't line up to getting me into many rooms in the VC world, especially pre-pandemic. I had to pay for access, knowledge, and I think that's one of the dirty secrets in venture that not a lot of people talk about, but being a part of other VC funds and, even reviewing over 500 VC funds over the last 6 years, that's given me confidence in my own strategy and how to play and where to play in the industry. so that I can actually compete versus just play and get destroyed.
I love how you call it pay to play, because you also said there's one thing you will not ever agree to, which is VC funds getting asked to pay to pitch family offices. I mean, how the fuck does that happen?
Don't do it. If anybody gets approached by somebody saying we will pitch or you pay to pitch family offices, don't do it. For many, many reasons, it gives terrible signals to future investors. Oftentimes, the investors, even if you get investors from that activity, they're not going to be investors that you probably want because they're not looking out for what's best for your business. I mean, especially if you're early stage, it makes absolutely no sense. It's like taking formula from a growing baby. Why would you do that? And if you shouldn't do that. And I think a lot of people get misled, but especially in a hard funding climate, it's attractive to hear there's a network of family offices that you can pitch to. Unfortunately, though, a lot of those family offices and some of those groups don't even know they're getting pitched to and don't even know what they're getting pitched to. So it's not, a lot of these aren't like matchmaking type things. And it's more of like solicit, pay, pitch, see what happens. And I think, for emerging managers and startups, do your best to avoid those scenarios at all in any costs.
Absolutely. Desperate times call for desperate measures, but you got to know where to set your bar on when you need to actually say no to certain things. I mean, for example, this morning, my partner and I were put on a call from, a regional investment bank that we know, thinking that we were going into an LP family office pitch conversation. And the conversation was totally the opposite. It was one of the family members pitching us on investing in his startup.
Yeah, that gets
and we
weird.
were like, what happened? We were just like, we just called it out right away. We were like, there's some mixed signals here. We just want to make sure we're on the same page. So you got to be transparent. You got to sort of talk openly about what your expectations are versus the other side of the conversation.
Well, yeah, I'd also say, family offices experience that as well. Well, they have a lot of service providers and stuff, try pitching them unnecessary services through these organizations that say you can be a part of this organization with other family offices and services. And sometimes startups are in those services where the family offices have no idea what they're getting pitched. So you also got to realize that from the family office perspective.
Well, my favorite, actually, before we move on, is the family office conference networking platforms who, ask me to come and speak on a panel. And then when I inquire more about the details, it obviously comes out that there's a $5,000 to $10,000 entry cost for me to go speak on a panel and no expenses covered as well. So thank you. But I'm not flying down to the Hamptons to pitch your family office network where I have to pay $10,000 to be there.
They want you to pay them to work for them. Interesting model there, huh?
You know what I do actually, funny enough to do this, I do reference checks beforehand. Before ever going into any pitch conversation, I actually message people on LinkedIn saying, hey, I've just been asked to speak at this event. I saw that you're one of the guest speakers. Can you tell me about your experience or what it's like? And a lot of the time they come back and they say, sorry, I'm not going to be there this year. Not sure why my name's on the list. So
yeah, that's tough.
There's a lot of sketchy stuff out there, but I'll save that for another conversation. You mentioned all the 33 startups and 17 VC funds. You've done a lot over the last 5 years with you and your family office. You've been very active. You've launched the VC fund. You've done 50 unique deals, as you mentioned, 33 startups, 17 VC funds, 16 pro rata deals. You've done 44% investments in people of color and 26 in female founders. So you've done a lot. And to put the cherry on top, you've already had 2 startups that were acquired. So with all of the activity that you've done over the last 5 years, what are some of the biggest lessons that you've learned that other LPs should hear about and learn from? Yeah,
well, I think one of the biggest is capital as a commodity. There's a lot of venture investors, especially old school, they may be doing it since early 2000s, believe that capital is kind of the big competitive advantage, especially if they're in a certain geo. Capital is a commodity, in my opinion, even in this challenging macro environment. Sure, it's more sought after, but it's still a commodity. So why would they take your capital over somebody else's? You have to answer that question. That's part of the reason I created a network of family offices that are qualified purchasers, but also operators operating typically privately owned companies that their family made their wealth on. So that's a big one. Capital is a commodity. Another one, patient capital is an advantage. So you can get caught up in all of a sudden you're getting sent a bunch of deals. Hey, this deal looks great. This deal looks great. But you really don't know what you like and what you don't like until you see more of a volume of deals. So it's important to see volume of deals to understand where you truly want to invest. I also am a proponent of creating a portfolio construction, making sure, especially if you're doing it out of family office or you're doing it off a balance sheet, make sure you identify check sizes, a budget, certain deal themes that you like, investment categories that you like. And as I said before, even investment categories that you don't like. That's almost as important to figure that out early. Another thing is, this is a one I learned pretty early on, but don't wait for deals to come to you, especially if you're a family office. It's easy to have adverse deal selection very quickly, and everyone has some form of that to an extent, but you need to be asking yourself, why is this deal on my table? I mean, I saw deals from San Francisco and Boston in 2018 when I didn't even have a formal fund, but people found out that I was in angel investing, and I said, well, what's going on here? Why isn't this getting eaten up in these popular ecosystems? So I think that's always important to ask yourself, why is this deal on my table? On top of that, I've learned to be more proactive. So using the internet and stuff for research, finding categories that I like or founders that I admire, and just tracking stuff like that to be proactive if there's ever an investment opportunity that arises from stuff that you're interested about. And then another thing too is like the deal flow channels, being very practical about like creating and then also nurturing deal flow channels. And I'm a proponent of you get what you put in, and I think it's really important to make sure that you share deals with others if you want deals shared with you. So I've been trying to be really intentional about deal flow sharing now that I have a portfolio that's improving. And I think having a lot of partners is also a good way to minimize adverse deal selection, which you will have. Even if you only invest in a couple of venture funds, you might think, hey, this is great because now I got some deal flow channels, but it actually might be the opposite of what you think, because they might keep you at bay as an LP that they just want for select SPVs or special purpose vehicles or for their future fund. So having a network of them kind of alleviates some of that as well. But those are some of the core things that I learned that have been really instrumental.
Dave, those are such amazing lessons learned. I mean, the first off, adverse selection is something I think we all need to address. At Ripple, we see over 2,000 to 3,000 companies a year, and it's not about investing in all of them. It's about choosing the right ones to invest in after you've seen all the horses in the race. If you only look at the ones that you've seen coming through the front door out of 50 of them, and you choose 10 of them, well, you don't really have a huge denominator to actually choose what are the best quality companies to look for. Compare and contrast, pattern recognition, things like that. I love also the fact you talk about portfolio construction. We do the same thing at our fund. And I just feel like a lot of people don't think about that. It's like check in, check out. But when you're investing off balance sheet, you really need to understand how you're choosing different type of risk profiles when you're making investments. And then last but not least, family offices are hard to find, which makes them hard for founders to find. So how are you going to get founders to come and pitch you when when VC funds can't even find you? So all those things are just such amazing comments that you've laid out for a lot of our listeners here. So thank you very much for sharing. Is there anything else you missed? Because there's such good points there. I can't imagine you forgot any.
No, I mean, those are a lot of the main learning lessons that I had. I think that covered most of it, but thanks.
No, for sure. Well, I love all those things, and I'm sure we'll have a lot of questions from our listeners. But before we wrap things up, we always like to ask our guests for their fast favorites. So first off, what's your favorite podcast?
So this is where you can't say Tank Talks. So I'll say Venture Unlocked with Samir. Actually, I'd heard you two talk on that podcast as well. So that's pretty cool. But that's my favorite podcast, I'd say. Yeah, Samir Kaji. Definitely one of my favorites. And thank you for listening to the podcast I was on. And sorry about the F-bombs on that one. That's okay. That's all good. Favorite newsletter or blog? I'd say Fred Wilson's blog. I've learned so much from that, and it's still, to me, just behind the scenes VC that just keeps killing it, and not enough people talk about his savviness, in my opinion.
Absolutely. It's definitely one of our favorites and ones that we share with all of our founders of the portfolio. So thank you for sharing that. Second or third favorite tech gadget?
I would say my One Wheel. So that's an electric skateboard. There's an app with it to adjust it to different riding styles and whatnot. And I absolutely love that. It helps me strengthen my back and core and teaching this old dog new tricks.
That's amazing. That's the first time we've heard that, number one. Number two, I didn't know there was an app to control it. And third, I didn't know it was like a workout. I guess it makes sense that it is.
You're constantly balancing. Yeah. So I had back issues a while ago, and I wanted to constantly do stuff to improve it other than just PT and lifting. I wanted to do something fun. So I looked into stuff with balance. One Wheel came up, and I was never a skateboarder or snowboarder growing up, but it's been a lot of fun, and it's definitely a fun gadget.
That is really cool. All right. Favorite new trend?
It doesn't matter where you live anymore and what ecosystem. For a guy that's in Wisconsin, I absolutely love that.
That is definitely the best thing for a lot of us outside of the core cities. Favorite book?
Democratizing Knowledge by Elizabeth Yin and Hung Pham at Hustleverse. Or Hustle Fun and Hustleverse. Yeah, Hung is at Hustleverse.
Did you get that at Camp Hustle?
I did not get. I bought it. I'm a huge proponent of buying from creators, including startups. So I don't like free samples and whatnot because they worked for it. So I like purchasing. So I actually bought it online.
Oh, that's really cool. And last but not least, your favorite life lesson.
Build upon your failures, but do it in a way where you learn from it. Because failure isn't always a journey to success if you're not learning from your failures. And being a competitive person, that was really hard for me because I didn't want to fail and being perfectionist. But the journey of learning through not succeeding is a way to lead to success.
Yeah, suffering without pain is a great way to learn how to make yourself better, which is awesome. So thank you so much for joining us in the tank today to talk about how LPs are thinking about the VC industry right now with Dave Sachse, managing partner at Sachse Family Fund.
Thanks for having me, Matt. It was a blast.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter at Matty B. Cohen or at Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,